Shane Moran, and I'll be your host today. And I have we've got some great news all over the place. We're going to be going to Talking Gold over at Andy Maguire in the UK very shortly. He's got some information that he'll be sharing with us today. You're not going to hear anywhere else, all right? So stay tuned, fasten your seatbelt. But just before we go over to Andy for Talking Gold, I just want to let everyone know in the Kinesis community worldwide that we are putting together a very special webinar with the corporate team talking about all the projects that are ongoing, that are exciting, that are historical in my opinion. So stay tuned for that announcement on when this webinar will be upcoming. So we'll bring everyone up to date on that. And so with that, let's go over to the UK, over to Talking Gold with Andy Maguire. Andy Maguire, how are you doing today?
Great to be with you, Shane, of course, and looking forward to having a catch up.
Yeah, well, first questions first, because I'm basically feeding back questions that are coming in here, and especially some of them are coming from me, is that I see these premiums all over the place, and we're talking again physical gold and physical silver. The premiums seem to be getting out of control on the high side, and it doesn't look like the price is bumping up to match those premiums. Maybe can you just walk us through what's happening in the markets?
Yeah, Shane, that's actually a really good question, especially as gold and silver were heavily sold in the paper markets. Now, if you remember last week, gold and silver was subjected to a full week of Monday to Friday. And I call it orchestrated capping because basically when we're talking about premiums like this and we're talking about strong demand, you shouldn't be having a falling price. Now, given the action was blatantly counterintuitive to what we were evidencing into a very strong physical market, which by the way, was commanding very strong wholesale premiums and rationing for any kind of size that we want. So when we talk about size, we talk about tonnage, and it's simply being rationed and spread out amongst dealers. So if we're going to the refiners now, so in view of this divergent action, this week, let's concentrate on the lagging fundamentals, which is kind of what you're talking about. And that's going to, because that's what's going to limit the scope of this paper-centric selling and propel a physically driven rally into the end of the year. And that is the key. It's got to be a physically driven rally. Otherwise, when we see margin traders coming in and just never intending to take delivery, they take a position and they are borrowing that money from the market makers who then aggregate those positions and literally find it very profitable to come back and clean them out. So, but what we're saying here, what is not yet factored into the disconnected algo-driven technical selling is a very recent move by China to secure as much raw material as it can lay its hands on. And this structural change in bullion flows has definitely not yet been reported by the mainstream media, who have misread a reduction of flows of bullion from the West to China as a lack of demand for gold, whereas actually quite the opposite is true.
Andy, can you just maybe expand a little bit on that, on how, because this seems like China all of a sudden is coming out of nowhere with this news. Can you maybe expand a little bit on what's happening in China?
Yes, Shane, really happy to do so. I mean, last week I drew a little bit of attention to a very recent move by China to circumvent the LBMA bullion banks and the LBMA refineries, and what they were doing is directly obtaining gold doré bars for themselves. And now this is fully confirmed. A couple of weeks ago, or a week ago, I already had information out, but now I've confirmed this by 3 separate sources, including a trusted Chinese contact. And so far, this activity really has completely, this is the amazing part, it's flown under the mainstream media radar. Now, look, that's unlikely that it hasn't been noticed, because more likely this news is deliberately being withheld. And I know for a fact that this has been the subject of discussion by at least one first-tier LBMA member bank after they ran into the same situation as us, namely being restricted for supply by refineries struggling to get the raw product to refine to give to us. Now, this also has to be on the radar of every other market-making trading bank operating in the over-the-counter and the COMEX markets. And it's almost certainly will be the reason we evidenced large margin increases in both gold and silver last week into what was 4 weeks of flat prices following what was a fundamentally counterintuitive 8-week sell-off. So that really had a lot of people puzzled.
Now, Andy, you mentioned earlier that, and again, with China in mind here, and China getting involved heavily into the silver area, can you maybe just talk about that? Maybe introduce this, what's happening there on the silver side?
Yeah, because this is unprecedented. And we've got reliable information that China has also aggressively moved into the silver market, buying mine supply in very large size. Now, this has never, ever happened before, and it will tighten up wholesale supply really quickly. Now, we're already evidencing this, so much so that Western dealers are having their allocations cut into what is already a very tight supply. Now, this could well explain, now this is interesting because this could well explain why we saw an unprecedented and totally unnecessary 14%, $2,000 per lot increase in SI futures margins into a 4-week flat price following this disruptive 8-week sell-off. So look, there is only 2 reasons that a margin increase, and what people know what margin is, it's, in other words, how much you have to borrow to run a futures contract. So there's only 2 reasons a margin increase of that kind of size. We've never seen such a large percentage increase on an overnight increase in other words, borrowing costs for these contracts. Now, there's only 2 ways it could be justified. One would be a very large price rise, or we evidence some very disruptive volatility. Now, look, if we step back from a 10-minute chart, you'll see that neither condition was present. In fact, gold and silver futures have been in this flat range through the last 4 COT weekly Tuesday cutoffs. And people know that the market reports every Tuesday and it's delayed till Friday, but they report exactly where the structure was. But those prices were absolutely almost flat in the last 4 weeks. And as of today, which is another Tuesday cutoff, COT cutoff, we're also back in that same range. So that's nearly 5 weeks. There is absolutely no credible reason for those margins to have been increased. So I see these margin increases implemented because the market makers are withdrawing real open interest, which is liquidity, because they're beginning to lessen risk exposure in these changing conditions. When you've got such a huge supply-demand imbalance, then you're going to need to reassess your risk reward. Now, there's very tiny premiums in bullion banking, so you don't want to be taking those kind of risks now. But let's not forget what broke the paper market, because this is what it leads into. What broke the paper market in March and triggered a $400 rally in gold and a $10 rally in silver was the blow up of the paper market's exchange for physical conduit. Now, look, we looked in granular detail in past webinars exactly how this exchange for physical facility blew up in the market makers' faces, and how on a single day it cost first and second tier bullion banks and trading houses literally hundreds of millions in losses, much of which is still unrecovered. Now, if people want to go back to, I think it was episode 8 or 9, pretty much if you go back to the March area, April, May, we uncovered this story in real detail and explained exactly what happened in granular detail. But really what this was the beginning of the exit of the banks who used to utilize the COMEX as a legitimate hedging or arbitrage trade. But risk appetite dropped away under this EFP conduit, we call it the exchange for physical conduit. And that, because that failed for the first time since the COMEX was formed over 40 years ago. So spreads are too tight to take those kind of risks on again. The banks are not going to do it. So bottom line, if we cut to the quick, what happened in March of this year was this 10 times larger over-the-counter gold foreign exchange market, these liquidity providers who were traditionally long over-the-counter positions, and then they delta hedged themselves short against these over-the-counter positions on the COMEX casino. However, this largely arbitrage trade relied on no one asking for physical delivery. Go figure. And that's what happened. Because what happened, if you remember, as we led into March, there was 30 days of absolute counterintuitive paper market centric selling. And by the 23rd of March, and this was so overdone, by the 23rd of March, the paper market had pushed the paper price so far below physical demand levels, very large competing sovereign and central bank size spot index positions moved in to demand physical delivery, causing, and don't forget, the over-the-counter market, as we know, is not a physical market. The over-the-counter market is 99 ounces of paper backed by 1 ounce of gold. And that goes all the way back to the Reserve Bank of India report in 2010. It hasn't really changed. So we've got provenance of that number. But we also know that the COMEX traditionally is a 99.9% non-delivery market. So basically, we're using in order to facilitate this trade, the COMEX was needed to hedge these positions. And really, when you're talking about it, it was paper to paper. And this is what burst on March the 23rd. This broke the paper to physical game. Never seen that in 40 years. There was no physical to back the trade. It's as simple as that. Now, since then, the COMEX casinos scrambled to restore some degree of credibility to do this. They brought in physical. We heard, oh, look at all this physical coming into the COMEX vaults. But all it did was provide an illusion that physical backs up the COMEX contracts. Now, given the lack of outflows into strong delivery requests, it is clear that this is simply not the case. And having exited the EFP risk trade in March, the conservative banks, and a lot of them are European banks, second-tier banks, but they've made a big market in this contract. They are still evidenced as steering clear of this risk trade. However, having drunk the Kool-Aid, we're seeing some evidence of risk appetite once again growing into a cap price by some aggressive funds. Now, look, this is bullish. Such an imbalanced paper to physical condition has not actually been evident since March the 23rd. And we all know what happened when that blew up. And what I'm warning here is that we're entering into a condition where it looks like it would all blow up again. And although no drama is evident in the exchange for physical conduit, you're looking at the premiums. Yeah, I mean, they're fairly consistent. They're higher than they should be, but they're fairly consistent. But we're seeing signs of another blow up building. Now, in the scramble to restore credibility, the COMEX set itself up as a physical delivery market. And really, given the slowness to discharge October delivery liabilities, which are still standing on the books with only a week and a half to go, this raises a red flag. The consequence of this has not yet been realized. This is an equally, if not more bullish condition than we experienced in March. So are we positioned for it? That's my question to people. Really what we're saying is the COMEX is unwittingly in the crosshairs as a delivery market. This was never envisaged, and with bullion difficult to obtain elsewhere in any kind of size, when we talk about tonnage size here, at paper-induced prices, these current delivery demands have caught these orchestrators offside into a technical and really deeply, fundamentally oversold condition, which historically could have been squared by simply adding more paper supply, but not in a physically delivered contract when people come and seek physical delivery. So this exchange for physical market is once again a balloon getting ready to blow up, only it's way less liquid than it was last time. So yes, we've seen people will say, yes, but open interest has reduced, so perhaps it's better. No, yes, it has reduced, but it's the real open interest that's exited the COMEX. This leaves the residual open interest that is there, paper, much more paper-centric, and vulnerable, especially into a deeply fundamentally oversold condition.
Well, Andrew, I have a question for you. You know, we've seen this, like you mentioned, the smash down in March, and then the rise, and then it's come down a little bit, not a lot. But what would you say to someone, for example, that is saying, you know, man, I missed the March. I wish I could have bought gone all in March, and they're sitting there accumulating their cash, waiting for silver or gold just to kind of maybe go down one more time, or what would you say? Because I'm seeing red lights flashing everywhere, and is that like playing with fire, or what do you think?
Yeah, I think so. And I think because what we're talking about here, a lot of what we just discussed is not factored in. Now, plain and simple, yes, people are saying, well, look, I think when you have this COMEX-centric view, we have 40 years of history, a non-delivery market, and people are conditioned to say, well, okay, let's just say it looks like we're going to come down again. We seem to have lost some upside momentum. But what I'm saying is what we need to do is really bring back into the fact the wholesale market view, which is so often missed by the paper-centric guys. And so what we're seeing is the aggregated wholesale bids are very, very, very close to the market price right now. We could have a look at a little bit closer to that in a minute, but what this action is actually telling us, what all of this action is telling us, there's two things it's telling us. From a supply-demand perspective, both are fundamentally bullish for the future pricing of both gold and silver. Now, obviously, if you're trading a 10-minute chart and you're margined, or you're looking to get a little alpha around your positions, which is fair enough, then you need to know, well, should I maybe be waiting for a lower price? Well, I've always had I've always had the philosophy, never count these guys out, but there comes a point where you think, well, you know what, because we know where these physical buy levels are, and we know that they're not going to allow to be filled, because what happens is, if you move into a level where the aggregated physical bids are, then what it does is it front runs the ability for the insiders to short cover their positions, because they don't want to deliver. And if they see a lot of orders sitting at a level, and I'm talking about levels in gold that are really only about $10 under where we've just recently been, and in silver, really around about maybe maybe half a buck under where we are. Why would you risk taking a price so close to that interest level, and to actually be front run? Now, these guys they're not stupid. They are now looking also at these supply demand disruptions which is definitely not factored in. So back to China, really. Now, with China now very recently evidenced as strategically front running every available ounce of African doré bar supply at a significant discount to spot. Now, I'm talking about some $300 an ounce below London fixed prices is not an unusual price for doré bars coming out of Africa. And this is not just, and we're not talking about the big guys, talking about the little producers. But it's not just enabling the PBOC to secure thousands of tons of global raw supply at very close to all-in global mine costs, but also to stealthily exchange depreciating dollar reserves. And I say this is the 2000-odd year art of war, Sun Tzu, and they are definitely employing this tactic. This move is robbing the LBMA of the captive cheap mine supply they've relied on to be able to suppress the gold price in the global markets. Now, this is occurring at the margin. So, right at the margin, it only needs a tiny percentage of supply disruption to alter the paper game that has stretched itself to the limit in suppressing the physical market. Now, obviously, the big names, I'm talking about the major KYC producer, and the big guys, they don't have to discount bullion inside the LBMA conduit by more than maybe 1 or 2%. In fact, It takes years and tens of millions of dollars to secure an LBMA refinery accreditation to lock in these kind of tight spreads. But really, it's not that supply that's under attack. It's the vast peripheral supply that is actually under attack here. So look, tighter regulations have already tightened the know your client process, restricting the ability for the LBMA banks to bring in cheap doré bars into LBMA refineries. This has been going on, tightening that noose for some time. And fresh legislations over the last couple of years have made the LBMA refineries directly accountable, refineries themselves, directly accountable for the know your client process, which is anti-blood gold process. Now, this had already put all but the most verified doré bar sources on the blacklist.
Blacklisted? Wow.
Yeah, up until recently, some of the Dubai refineries had been turning a blind eye to these so-called blood gold bars, know your client, in other words, un-KYC bars, and they would either end up directly in India or subsequently end up being re-refined by the LBMA refineries, and that would be a way of successfully circumventing the regulations. But that's kind of stopped now. This cheap supply that has really enabled the profitable trade conduit by the Bank of International Settlements, the Fed, their agent banks. Look, these guys are privileged to run gold accounts at the Bank of England to bring in large supply at a discount. Now, since 1919, the old guard, and that's the yet to be formed LBMA, because obviously that wasn't formed in 1919, the bullion banks, comprising of just 5 members, held a vice-like grip on the gold fixing process. So this secretive fix process was well coordinated amongst this cabal of banks, very small cabal of 5 banks, acting as agent for the Bank of International Settlements under the watchful eye of the Bank of England. And this allowed this cabal of banks to force captive producers reliant on bank financing into hedging or forward selling practices that incorporated these Bank of International Settlements price rigging FX management strategies. So essentially forcing unnecessary hedging or forward selling to maintain financing. But due to regulatory pressure, the fix process was ultimately opened up to competition. And as a result, over the last 5 years, the LBMA cabal have steadily been losing their grip on global supply. And as we've been noting for years now, aside from direct ownership stakes in mines, forests, infrastructure, China has strategically moved into offer better financing strategies, which these banks were previously captive to, which inevitably incorporate ownership stakes in literally thousands of producers. Now, with the ability to aggregate supply, China began to offer a better solution for many of these captive gold and silver producers, enabling a lot of individual producers to escape the onerous captive fix process set by a small handful of price setters. So began the slippery slope for the LBMA as they were opened up to competition. So whichever way you look at it, and as we personally are aware, a lot of LBMA's previous activities were facilitated by backhandering the like of Ugandan officials who would happily tax stamp hundreds of tons of gold exports every year stolen from the Congo. Now let's think about this. Neighboring Uganda has no gold. The Congo has lots of gold, but neighboring Uganda has a government refinery. Go figure. Why was that put in place? So clearly this is so incestuous. Now this cheap supply profited the bullion banks, but concurrently enabled the Bank of International Settlements, the Bank of England, to be able to lease into the market cheap bullion at a higher spot price. That empowering the dilutive sell, what that would do is empower this dilutive sell price window. And these physical sell activities, when sprung at an inflection point, we've all seen it, 2 o'clock in the morning or an inflection point, has provided a major tool for officials to contain the rising price of gold while rewarding the agent banks with cheap bullion. And although dwindling, this activity now abruptly ends. This is a big deal. China has ownership stakes in a vast number of African and South American mines. A lot of this supply is already flowing into China. However, China has now moved in to take control of the entire doré bar business. And over the last 4 weeks, this has cut supply to the insiders' refineries to the point Swiss and European refiners are struggling to get raw product to refine. So this raw product is not just flowing into China at a discount, putting to bed really what I think are erroneous conspiracy theories that China has been suppressing the COMEX prices, whereas in fact, they have been playing the long game, stealthily securing mine supply. And now what has our attention, and no doubt officials, is the direct unreported inflows of raw product into Chinese refineries, completely missing the statistics, which is undoubtedly, in our opinion, a stealthy way for the PBOC to accelerate the process of backing the yuan with gold ahead of an inevitable gold price reset. Now, the starvation of raw product into LBMA refineries has exposed the game that China has obviously gained sufficient control of supply conduit to dare to show their hand. And quite frankly, now when we're finding such difficulty in getting bullion in the West here, we know that China is actually up to something very, very big. And so how long before this impacts the paper market? Well, we see this before the end of the year. I mean, insider bullion banks such as Goldman Sachs and JP Morgan are full on buying physical gold and silver ahead of the price squeeze. But really, as far as the silver story goes, I'm going to actually provide way more on the silver story next time. But really, to kind of answer your question, look, if you're a stacker, if you are building a physical position, then you would just average in anyway. And I think, given what's coming down the pike here, I would not be sitting down waiting for a possible price dip because you could be left on the sidelines here, because when things start to accelerate here, and I really do think that this is a major change in behavior, something that was never factored in. I think it's time just to be in physical. I would not play the paper game, and you could be settled for cash.
Yeah, I think that's the key, is that we're always on this show talking about physical paper, but at Kinesis, it's only physical. We're only physical. There is no paper. And which brings us kind of full circle. When we started the call today, we talked about the price variance. And what I'm continually impressed and just super, super impressed about Kinesis is I cannot find, and I put a challenge out, I think a couple of weeks ago, and I'll put another challenge out. Someone find anywhere in the world where you can buy physical gold or silver closer to that paper spot price than at Kinesis, which is I'm blessed, and I'm thankful to Tom Coughlin, the CEO of Kinesis, for putting this together for us. Can you just maybe spend a minute or two just talking about how is it even possible that Kinesis is able to have such low premiums on the gold and silver, and we're talking physical again?
Again, because I think because of all the work that went in the previous years, although Kinesis is a relatively new company in the sense that it's digitizing physical gold onto the blockchain. In ABX, Tom Coughlin formed the Allocated Bullion Exchange way back in 2011, 2012. And what that did was created the infrastructure to create this physical, a physical exchange, digital physical exchange, really, electronic physical exchange, where you could actually now start to aggregate prices around the world. In other words, you could disintermediate the price from one country to another by setting up vaults all over the world, and then and of course gold and silver is fungible and can be exchanged between one location and another, exactly because a 4-9s bar is a 4-9s bar. You were able to actually bring this sort of aggregation into place, where you could actually physically have, you could have a real physical price, something that would actually be in a vault to be traded, that you could buy and you could sell, and it did not rely on paper. And I think we've talked about ABX before, but essentially without ABX, which is a well-proven company backing the Kinesis monetary ecosystem, without that, that's why you would not, that's why you're getting such great spreads. That's why we are getting such great spreads in the Kinesis system, because the ABX system is so liquid, and it has the infrastructure, and the whole system is so well proven and liquid that it actually can provide an aggregated price for a global aggregated price. And when you are buying a physical, when you're buying KAU or KAG, that's physical gold and silver. You're actually, that gold or silver has to be actually brought into a physical vault, and you own it. Therefore, it is not a paper price. And this is what I think, this is how, in a long, sort of in a more roundabout way, by adopting this system and by using Kinesis, you actually become part of the solution. Because every time you don't buy paper gold, and you actually use the Kinesis monetary system for what it is, which is an ability to actually take responsibility. In fact, I see this, the monetary system, I see the Kinesis monetary ecosystem as an all-important financial component of a holistic view of taking responsibility for ourselves and our families in all aspects of our lives. Gold does what it says on the box, as does silver, and both of which have served and protected generations for thousands of years. Now, look, I'm really pleased to see such a global willingness to re-adopt gold and silver as everyday money. Now, obviously, this could not be done without first securely digitizing your personal physical holdings and then setting it free on the trustless blockchain rails. And, you know, using this cutting-edge blockchain technology, Kinesis enables us to digitize our physical gold and silver into small enough units to use as an everyday currency. And essentially, our gold and silver are transformed into a fast, secure, redeemable e-payment currency. And once securely digitalized, we're able to spend, save, or hold our physical gold and silver assets in the ultimate liquid form. And this is exactly where Kinesis comes in. And sorry about my passion here, but I'll tell you, this is the most exciting thing I have seen in a lifetime of trading in gold and silver. Kinesis provides all the security required to trust your gold. This is through the ABX, the established ABX network. And it's always titled and accessible to you, but enables you to exchange your gold currency for any other currency back to physical bullion in an instant if you want. Also, unlike any other e-payment offering, Kinesis enables you to own a stake in the Kinesis monetary ecosystem just by using it. You share in the yields generated, and it gives everyone, no matter how small or large, to become your own central bank. It's not just about insulating ourselves from a broken banking system. More importantly, it's about taking responsibility for ourselves and our families in all aspects of our lives, Shane.
Well, that's very exciting stuff, Andrew, and you're sounding like me, excited and fired up about what's happening at Kinesis, and it's really exciting. Look, if you're viewing this video here, I would ask you to like and share it with everyone you know, and rewind and watch it again and again and again, because if you understand what Andrew just said right now, I think you're going to have a lot of people, Andrew, not sleeping in a positive way for the next few days. So with that, are there any final thoughts as we wrap this call up for this week?
Well, other than physical gold, physical silver, watch out above, because the reset has to come. It's impossible that the reset isn't coming. Okay, if you're trading a 10-minute chart, you need to be on your toes. But I think as far as the majority of people are concerned, and certainly do what the big boys are doing, buy physical and buy as much physical as you can.
Well, thank you so much, Andrew Maguire, talking gold again and also silver.